Now they say unit trust doesn't make money. I personally experienced the same. I put a couple of thousands inside until today. It's stuck there because I haven't made money, right? One of the main reason is whenever you do fund switching, the buggers already take 5%. And the funds over a period of time, if they make less than 5%, I lose money. If they make slightly more than 5%, I barely scrape through, right? So is it real that unit trust can really make money? So today we have my friend here, Arthur, who is an expert in asset management, who is going to help us debunk the myth of unit trust. So you're watching Powertalk, is where we talk about money, finance, family, and life. So today we have Arthur here, who's passionate about helping people to actually grow their money through unit trust. So, Arthur, welcome to Powertalk.
All right, thank you, Chunho. Thank you for having me here, and it's really, really great. Sharing about my passion about helping people to start investing, especially with vehicle called unit trust, where many people were like, "Oh no, this is like another
it's one of those."
Yeah, it's one of those.
Right. I think for those who are watching, right, they obviously have some questions, right? Like, who is this young chiku telling us about unit trust? Hey, why don't you tell us a little bit about yourself? Like, how did you get here?
All right. So, thanks for the question. So, how did I get here, right? Maybe I'll start off a little bit early on a younger age, right? Where I come from a small city. So, it's called Kuching. Some of you may know. It's in Sarawak, not Sabah. Some of them mistaken. It's okay. So where I came from, there's not much. It's definitely a little bit slower on that side. Right now they're still picking up and whatnot. But back then, when I was growing up, all this investing thing doesn't come to me very often, and also not too much about not like these days. There's a lot of education going around. It can be a lot of things about copywriting or becoming a YouTuber or whatnot. But back then it's even slower. So when in my younger days, I actually live a pretty decent, comfortable life. When I wanted something, some toys, I would just wah, and then it comes to me lah. My dad will buy lah.
Life was easy lah.
Yeah, life was easier, I would say. So along the years, I remember when I was 12 years old, so about primary school, something what happened in the family. So my parents were arguing a little bit more, and they probably have some tension between. And my dad will usually come back very late, sometimes a little bit tipsy and whatnot. So I was curious what happened. And then along the way, I actually found out that my dad got into some financial issues. So I didn't really get the full picture of what happened back then, but I say from my sisters a little bit of here and there. So apparently he invested a huge amount into stocks or whatnot, and he don't know what he don't know back then. So he heard people say about investment, unit trust was part of the so from there he lost a lot of money because he also heard about like, oh, the market's gonna come back and the the overall market is gonna be great. So he actually, instead of just investing what he can afford, he took up more. He borrowed some of here and there a bit, just so that he can make more for the family, just so that we can have a more comfortable living. But it turned the other way. So throughout my secondary school life, it was kind of challenging, not just in terms of finance, but there are some ups and downs in the family, like emotional, mentally draining way. So that was this investment thing was a taboo topic in the family. So um, along the years, I somewhat go through uni, uh, coming out to work. I've gotten exposed a lot more about investment, and it's out of I'm not sure why, but it just came across, and I've met like even people doing crypto about 5 years ago. Uh, that back then nobody knows about what's crypto, right? What's Bitcoin? All these things came to me, crypto, stock trading, and whatnot. So I was curious, hey, how come I came across these people, and these people can still make money through investing one? How come whatever investment they do, some people on the other side make money one? So I thought like, oh, is all this a scam or whatnot? So for the last 5 years, I've also been in the industry, education industry. So I've actually exposed myself to many individuals, many gurus out there that are teaching in many other things. And I've actually picked up like, hey, it's not really true that every investing is fully scam or it all doesn't make money or whatnot. So it opened me up a little bit more. Then back in 2020, that's where I started to open up that topic, like investing on Google, see
Who
what kind of
inspired you to actually start searching or learning more about investment? Rather, who or what inspired you
okay.
to start digging?
COVID started actually. Uh, stuck at home.
Right.
You know,
I think COVID inspired a lot of things, right? So for people
yeah,
who doesn't cook, they started cooking, right? And
exactly,
then
exactly.
I even know of people 17 years old, they started learning about digital marketing, and in that 3 years they made a lot of money as a result, you know. So you probably gone on the same route, started learning about investment.
Yeah, exactly. COVID made me realize that hey, money is sitting in the banks. What am I supposed to do with it? Not getting any younger. What if I want to start a family? What's next? Do I have enough? And all these questions popped in. Then yeah, go Google searching, look into properties, look into stocks and all these things.
So how do you
And
eventually end up, being so passionate about unit trust?
yeah, getting there. So I actually wanted to in after through some research and back in 2021, that's where I wanted to start investing into property, right? Because that is something tangible, something safer in the top of my mind back then lah. But then I went on searching. I met one of my real estate agents. She but throw me a bunch of questions like, oh, what kind of property you're looking for, for investment and whatnot. Then this one last question pop up, ask me, hey, are you ready to commit for 35 years? I was like, wow, that question hit me like a truck, 35 years. How old will I be then? Probably about 60 plus. Don't reveal age. 60 plus. So I was like, no, no, I'm not ready actually. Because I still have, I'll prefer to do it in another way. I'll prefer some liquidity. So I was like, okay, property wasn't my thing. And then she asked me, hey, since property is not a thing, she's doing crypto. Yeah, crypto. She introduced to me crypto, what it's all about. And then I hop onto it with like 70% trust and 30% study about crypto.
Okay.
Yeah.
She must
And
be quite attractive for you to put 70% trust.
uh, you got 70%, right? Yeah. So I hop on it on the later of 2021, which later of 2021 was kind of like the peak, right? And then that hit me, right? In the sense that market came down, even for crypto. I've lost quite a fair bit, I would say. Um, it is an amount that not only that I can afford to lose, but it's a little bit more. I stretch out a little bit. Yeah. Then that's where I think, wow, property too illiquid, but stock a bit, I mean, crypto is a bit too volatile. So what's in between that has middle risk, but still can make decent return, has liquidity. So that I search up. Oh, the thing that always pop up was public mutual. Nothing wrong with public mutual. I think they have great funds as well. They are longest in the industry. But I wanted to be in somewhere that also very established, but has their own strong stance in terms of local market. And that's where I stumbled upon Kenanga. And Kenanga, that's where I actually learned about unit trust there. And that's where I started off. So did learn before that, crypto, a little bit about stock. Then I went into unit trust into Kenanga.
So in other words, you actually explored quite a fair bit, right? And then you started. Your first choice was actually property, but then again, the challenge that came to you: are you ready to commit for such a long time? And then that question sort of led you to, some other different asset classes, right? And then you went into crypto, sort of got burned. Can I say that? All right. And that's where you started looking for something that has a much lower risk. And that's how you got into unit trust. All right.
Yeah.
Okay, cool. So thanks for sharing your story over there, right? And I think one of the biggest lesson from your story was actually the know-how as well as the ability to actually manage personal risks, right? Like, for example, the story of your father, right? He wanted to make it for the family. He went into shares, right? And like yourself also, you went into crypto, and a lot of times because you heard people say something, right? And then you went in, right? And to me, this is what a lot of people do. And it's almost sort of like gambling, in my opinion, right? But again, when people go inside, they didn't know better, isn't it? So if there was a way to actually help you, a process, or a way to actually help people to manage the risk such that they can still make money, and if they lose, they can actually eliminate that risk, or perhaps don't lose as much that it doesn't actually hurt, that will actually help people to grow a lot. But we'll keep that for another discussion, So for today, since you've been studying about unit trust, and you actually believe it so much that you now help people to get on board unit trust, I'm going to ask you that very first question, right? Even my personal experience, people say, hey, unit trust cannot make money on the returns are so low, right? It's slightly better than insurance type of funds, slightly better, but cannot make money on But really, what's it like?
What's it like? I want to ask you, what's your experience like? Because many people have different experiences. So far, speaking to like hundreds of people, right? They all told me different story one. Yeah.
I see.
So maybe help me understand a bit what was your experience. And then I see which statistics you fall into.
Okay, my experience. I think first and foremost, I got into, just to give you a little bit of perspective, right? Before I graduate, my buddies, my besties, brother inspired us to actually get into shares, right? So before we got into shares, I actually I studied. The first book that I read was something about, I can't remember the title, but it was by Peter Lynch. It's something like Beating the Market or something like that, right? So it was fundamental investment. Then I learn about Warren Buffett's investment strategy. And then with the scholarship money, I went in, right? I went in. And that time, people will probably know how old I am now. That time I haven't graduated yet, but that time was where the American Twin Towers was bombed. Then I saw the opportunity. While people are panicking, selling, I went in. So I made quite a fair bit. And then after that, all the way through to before the subprime crisis in 2008, right? All the way through since then, I average about 30% per year. So in other words, I did better than EPF lah.
Way better.
Yeah, so my funds grew quite well, you know. And then a friend at that time graduated, he went into asset management, and then he came to me. So I got into unit trust simply because I wanted to support a friend, right? So at that time I asked him, hey, what kind of funds do you have? Blah blah. So that time, obviously China was coming up, right? Because of the Olympics and all that. So I picked a fund that is more related to the Asian market, right? Because that time it was doing quite well. And so that's it. I just bought it. I trusted my friend to actually, be able to advise and, help me to manage. So I left it there, right? Then every year when the thing came, it started to like, hey, why, when you show me the fund seems to be doing well now, it seems to be dipping, then we didn't even have conversation about switching fund because I didn't put a lot of money in there. So I just left it there. And then I stopped the monthly contribution and I just left it there. All in all, it didn't really make money because when I got it, it was probably at a high point. Now it's like dipping. So I just kept it there and I think it's still going, I haven't took it out, but I sort of, from an account standpoint, I wrote it off. So from there, I'm like, this kind of return, I think if I invest myself, I do better, I waste my time. So that's my perspective about unit trust, right? So yeah, share your thoughts. And I think a lot of audience probably have the same experience, because recently one of a friend told me, unit trust, you switch fund 5% already. If the bugger don't make 5%, you lose money already. If you make 5%, then you don't make any money at all, because when you switch fund, it's 5%. You put in 5%, you take out 5%, you switch on 5%. 骗人的啦, Yeah.
Okay. Thanks for sharing me with your experience. I address the charges first, right? That's one of maybe the elephant in the room. So I'll address that elephant first. Technically charges, right? There's 5 charges in fact, right? First charges is about sales charge that you mentioned about. Hey, you come in, people charge you 5% already. Why so high one, right? Actually that charge depends on the funds itself. The sales charge differs from different funds. All right. At the same time, companies, or I would say advisors, sometimes have the ability or capability of amending the sales charge depending on the advisor or the company, right? So technically, you don't have to be charged 5%. Yeah. So I would say you have a negotiating power in that sense, right? So some advisors would actually negotiate, hey, you come with a certain bigger amount at a faster time, I can actually negotiate lower for you.
You mean the charges are negotiable?
Sorry, I can't hear you.
You mean the charges, the fund switching charges are actually negotiable? So in other words, can it actually be zero, right?
Zero is a no. But as far as I know, some companies can go down to 1.5% for sales.
What? Nobody told me that. Okay, this is interesting. Yeah. Okay, go on.
Yeah. That's for certain asset classes, right? There are funds that can do zero charge. All right. Yeah. For
What?
example,
You're
yes,
kidding me.
especially for companies, right? They invest a huge millions, right? They invest in millions, and companies cannot take so much risk. They either go with money market or bond fund, which
Right, right.
we can choose not to charge. Yeah,
But let's be real, right? I mean, people on the street, how many people can actually put in millions, right? So
yeah.
for people on the street, can they get like 0%, or what's the minimum that they can actually push it down to?
0% is, I think, impossible, because at the same time, your advisor
But you said there are some companies who actually have 0% charge, right?
companies, because they come in with a huge amount, like millions, and at the same time
Oh,
they have a certain holding period, right? And that also comes in if, let's say, they probably be coming in with like money market, which is really very conservative.
right. But
Just
let's
that.
let's talk about
Mm,
the what's in it for normal people like you and I lah,
okay,
right?
okay.
They
We'll talk about that.
obviously
Mm,
not being able to come in. Maybe a handful may be able to come in with their millions, but majority won't be able to do so, right?
yeah, yeah.
So, but I am glad to hear that the fund charges are negotiable. Nobody told me that, So
Yeah.
what's in it for them? Like I said, most in my own experience also, I didn't make money, and because of the fund charges and whatnot, people tend to lose money than actually made money. So what's in
Mm.
it for them? How do you actually help people to do better than EPF?
Okay. Okay. Thanks for asking. I want to address, not all companies can let you negotiate. So some advisors really cannot do anything. Some companies allow that, because yeah, they really want to come from a space of helping the clients. So if I put a point of view like this, right? Hey, if 5%, right? 5%, if I charge you max, means you are being charged as long as you are investing with me. So if you invest with me for 20 years, your fee is only that much. And for any fresh funds.
As in
So
five
if you don't,
percent per year or 5%?
no, first 5% for any fresh fund that comes in. And as long as you're staying invested, there's no additional sales charge.
Including
So
switching funds.
switching fund is another different type of fee, which
Right.
some companies charge, some companies don't charge. For example, on Kenanga side, between Kenanga fund, we actually waive for our clients, so we don't charge for switching. Yeah, depends on companies.
Mm.
Yeah.
Okay.
So maybe there's another part where you mentioned the 5% switching. Some companies, depends on the funds, they do charge a minimum amount, because yeah, it depends on the fund. Coming back to the fund, so there may be some minimal charges in between.
So basically, if they come in for any, let's be neutral here, right?
Yeah,
Because we're not advertising for any company whatsoever. So
correct.
when they come in to pick up a fund, they get a sales charge of 5%, and that's it, right? Then if they want to switch funds or whatever, some companies will waive the switching funds, some will have a
Yeah,
minimal charge. All
yeah.
right, cool. But how do you help people to actually do better than EPF? I mean, I'm using EPF as a standard because they're like producing 5 to 6% per year,
Mm.
especially when it's nearing election, they will try to boost it up a bit, window dress a bit. Right? But
Yeah.
as in most shares, right? End of the year, they kind of try to push it up a little bit. So in this case, my personal experience is it didn't work for me, right? But how
Okay.
do you actually help most
So
people to do better than EPF?
okay. So two things. One is you have to look into the asset class that you're investing in. Maybe three things. Asset class, right? First, I talk about asset class.
What's asset class? Not
Asset
many
class,
people know what's
yeah.
asset class.
Asset class that comes in four types, right? One is like bond, which is income fund, right? So when it comes to
Is that high
bonds,
risk or low risk?
that's the low risk one, which gives us about average 4 to 6%, which is similar to ETF, right?
So in other words,
So
gain 4 to 6%, but if I lose,
it's about on par
so
or
it's
less.
you
Because
either up 4 to 6% or down 4 to 6%.
yes, depends on asset class, because the funds, how they usually work lah, based on a study for most of the funds, I would say when they are able to up, let's say 10%, the downside is usually half. Yeah, across most of the funds, except for high volatility funds or higher risk funds. Yeah, like small caps and whatnot. So bond fund is one where it has less, it's more conservative, right? Less return. We have mixed assets, which is mix of bonds and equity, right? That's the second one. Third one is the equity funds, where they are more aggressive in that sense, right? And last one is money market. Money market is where a lot of companies jump into, but bear in mind, if company invest into money market, the returns are taxable lah. So that's why
If it's individual,
individual is not taxable.
well, what's the risk like in money markets?
Money market is like another FD lor. Yeah, another FD lor.
Okay.
Yeah,
I'm sure each of these portfolio have its usage, right? So let's talk about like an individual, young and dangerous, right? Single, nothing much to lose, but maybe because they are capable, they have some income. What would you advise?
Okay, coming from that sense, right? Depends on the income. If let's say the person doesn't have a huge lump sum to invest, then we of course go with what you mentioned just now, auto debit on a monthly basis. But you gotta be aware about what kind of funds that you're investing into.
Yeah, that's exactly what I was asking.
Yeah, the track record, not just a track record, because past performance doesn't indicate future performance. So other than returns that you gotta look into, you gotta see the whole prospectus, right? The whole objective of this fund, whether it's a long term, short term, mid term, and is it capital growth? Is it income distribution? What kind of fund is it? So we focus more on capital growth, but long term. And another thing, a lot of people don't see.
Why? A person that's young and dangerous, that probably doesn't have the patience or the appetite to actually put in money for 35 years, right? so can you, if he was a young person, single, again, young and dangerous, what would you advise without being too technical about it?
Okay. Depends on their objective, actually, their investment objective. What kind of time horizon are they looking at? Right? We look at three things. If I were to draw into a triangle, each point has one thing. So financial goal, it depends on three. One is the amount they can invest into, right? How much they can start off with, or what
kind of question would you ask this person to help him decide?
Okay, so I'll ask like, hey, actually, I'll start off with, actually, what would you do with the money when you invest, right? Maybe help me understand, is it for retirement? Is it for building your children's education and whatnot? So we have
single where got building children's education.
Who knows, people start preparing first, right?
Yeah, you're right. Some people are more forward looking.
Correct.
Okay.
So it depends on what they're looking for. And then based on that, right, they already have a rough time horizon for it. Is it 3 to 5 years? Is it 10 years? Is it 20 years? Then according to that, right, then you mentioned young and dangerous.
So young and dangerous, let's go with 3 to 5 years.
Okay. Young and dangerous, 3 to 5 years. Then 3 to 5 years, young and dangerous. Okay. Then I ask them if let's say you were to be able to invest 100,000 today, how much are you willing to lose?
That's actually a damn good question, and it's part of the risk management as well, actually. So for those of you who are watching, keep in mind this question. If you're investing, how much are you willing to lose, right?
Mm.
So let's say the dude says, 50K lah.
50% lah.
50% lah.
50% is okay, right? 50%. Even when we study about the bear markets in all the during the recession, the past recession, past crisis, right? It's only down about 50%. So you're in good hands, yeah. So I would say, like I mentioned, if you can actually hold 50%, you can afford to lose.
So wait, just let me understand that. So that means based on your research of the past inflation trends, or rather past recession trends, you're talking about global recession, or you're talking about just purely Malaysian?
Global recession.
Global recession.
So
it's across the board, I would say.
Yeah, 2018, 2008.
So that means based on the track record, a risk of 50% is just about right.
Yeah.
Okay.
For a bear market.
But from experience, right, most people say 50%, but when they actually, like Mike Tyson says, people will have all kinds of techniques and whatever when it comes to fighting until they get punched in the face. Right, they have all kinds of strategies in their mind until they get punched in the face.
Yes.
So investing is actually the same, right? They think they may risk 50%, but actually if they lose 10% also, wow, they cannot tahan really.
All right.
So like, how do you deal with this?
So that's another thing I'm addressing, right? So when I say how much are you willing to lose, it's not that I'm going to realize your losses. It's unrealized loss, right? Along the way, what can I do for you, right? If let's say the particular fund that I allocate you into has potential upside according to the market and according to the sector that the market is investing into, then I would say either 4 things, right? 4 things. If let's say market goes up, either you take profit or you take out the whole thing, or actually 2 things: sell profit, or you actually leave it there to roll. If it goes down, 2 things: either you really again do nothing, or you buy lower, right? So
you mean buy lower? You mean you don't take out the funds, but you pump in some more money, right?
Correct. That is for the funds that has potential upside based on the sectors, right? So for those that doesn't have, of course I would say, okay, cut loss. Right.
Okay. So when you say these two things, 2 questions come to mind, right? Would you advise we're still at young and dangerous, would you advise the person to, average, like contribute monthly or one lump sum, and then depends how what direction the market goes, depending on which direction, then they either put in some more or take out, or regardless of the direction, they just keep contributing a certain sum?
Okay.
Which would you advise?
So if the person young and dangerous, really no commitment, right, I would suggest to average down. All right. If let's say the person already has a amount of savings that he can hold, if let's say it doesn't work for the next 6 months and he can survive through, by all means, you invest lower, right? So because through this bearish market, it lasts about 1.5 years to 2.5 years, usually on the bearish market. So that's the holding period that we foresee most of the time. If you can hold for that period of time, by all means, you average down with the additional money that you have.
So that means it doesn't. Okay, so it's a good thing that you said bearish market, because we are already in one, right?
Yeah.
And next year they're already predicting, some experts are even confirming that it's going to be a recession, right? Which is actually a bear market. So you said 1.5 years, etc. Like where on what basis do you come up with that timeline? Bearish market lasts about 1.5 years, 2 years. Like on what basis?
Based on studies, based on studies of the past recessions as well, past crisis, the average range is about there. But at the same time, I want to mention, right, when you mention recession, I don't foresee that there'll be going to be a global recession, right? It's more on the Western side. That's what I foresee, right? For the Asian side, there will be spillover effect but we wouldn't get hit so hard, right? And if you talk about recession, we are actually factored in already, like in the sense that we're easing into it already. There's no hard stop like, oh, this like maybe like 100 basis point of like increment or whatnot. We're already easing into it.
Right,
And
right. Since we're talking about that, why do you what makes you say that it's not going to be so hard for us, particularly Asia or like particularly Malaysians?
Asia, I would say Asia.
Okay.
And if I were to go specific into Malaysia, because we're in Malaysia, am I right?
Mm.
So Malaysia, we were just opening up like early of this year, right? And look at the numbers. Numbers don't lie. Because look at GDP of Malaysia these days. We're projecting we'll be end the year about 7 GDP. All right. So then next year, the following year, when it slowly slows down, it'll go back to about 4 to 5. It's coming back to like pre-pandemic days where the GDP is healthy, right? This year we open up. There's a lot of more activities. Maybe for you to relate, you just go outside on the weekend. You go maybe Bukit Bintang, maybe you go some malls. Is it empty or is it like fully packed that you don't even want to go out? Maybe question to you lah, right? And maybe you want to go to a restaurant, fully booked maybe. I mean, what recession, right? People are spending. Unemployment rate is gradually going down, and export is going higher. Month to month it fluctuates, but
right.
healthy.
So I think what you're saying here is the main indicator is the GDP lah, right?
Right.
So you're looking at the GDP and then you felt that actually it's looking at the trends, it may not be so bad lah, right?
Yeah, exactly.
Okay, cool.
Exactly.
Okay. So in that sense, it seems like it's not so scary after all.
Not
yeah, but
so
one
scary.
question that was in my mind, again, still at Young and Dangerous, it seems like you guys actually have funds to cater for people with a 3 to 5 years horizon.
Yes.
Oh, that's interesting. What kind of factoring in the bear market, what kind of projected returns are we looking at on a per annum basis?
Per annum basis, usually we look about stretch to 5 years in that sense. 5 years, across 5 years, is about 8 to 12% per year. Yeah. For Young and
8 to
Dangerous.
12. So 8 to 12% is sort of consider the higher returns and higher risk ones.
Middle to higher returns.
What about the really high return ones?
Really high returns on year. There are funds that make 60%. There are funds that are making 40%. So it depends on the risk appetite. So that one comes in a lot more management, right? When to really buy and sell. Ideally, we don't try to time the market, but we have time in the market. So
right. Again, 40 to 60%. So for those
year on year.
So year on year, right? Exactly. So for
year.
those who hear this and they are itchy about it already, what's the minimum layout?
Investment?
Yeah.
Okay. It depends on funds again. So they have their own requirements. But if you don't mind me being honest, right? For me, I would see my client base right now is more towards like 100,000 and above. But again, whoever actually needs help with investment, actually I'm more than happy to help out. But of course, coming from you, your audience, right? I'll be more than happy to do so.
So it's like they can just, let's say if they don't have 100,000, let's say they have 50,000 set aside or whatever, maybe more, they can just dump it into the funds and hope for 60K, 40K by the end of the year, or is there something they need to do in between, or something that you're doing for them in between? Like what's it like?
Okay, I won't dump them into a single one. Of course, understanding what kind of their risk profile. then I'll allocate accordingly into several funds. That's why it's a customized service. So it doesn't have to be a single fund, right?
So that means it's not like a particular portfolio, but it's actually managed such that it is 40 to 60% per year.
For the 40 to 60% is a single fund, but what I do is I allocate into one or two funds depending on the investment amount and what kind of risk profile you have.
To spread the risk.
Yes.
Okay.
Correct.
Which now leads me to so you have, well, the safe side is 8-12%, and then you have the ones that are quite crazy, 40 to 60% single fund, right? People who are curious, stay tuned. You may want to click the link down below so that let us know what you need and what you want, so that Arthur can actually get back to you after this. But this nicely segues to the next type of people who are probably in their, say, 30s, late 20s, going into 30s, people who are in their mid 30s perhaps. These are people who may be married and planning to start a family. So people who are planning to start a family, they will start thinking about raising their kids, which needs a lot of money. Education fund, and then perhaps even thinking about how to build up their retirement fund so that they can, live off a certain lifestyle that they want, right? Now, for these type of people, I've spoken to a lot of mothers. They are very, very risk adverse. They work hard for the money. They don't want to lose a single cent of the money that they work for. But at the same time, they are frustrated because they don't know where to go, right? Put in the bank, interest is not, not as they wish. FD is actually lower than the inflation rate right now, right? And to put into even unit trust to them is risky. What would your advice be for this group of people?
Okay. One thing I really got to point out, right? 90% of my clients, when they say their investment don't make money or it's risky, right? Most of the time they don't know what they're doing because their advisors don't advise them accordingly. They don't tell them what they are investing into.
Okay, so good thing that you brought this up. We're still at the group where they are, married couples, probably young parents, right? So you say they don't know what they don't know what they don't know, right? On the one hand, it's like, ouch, how dare you? On the other hand, I appreciate that because nobody has the balls to tell them that, tell them this, right? So this leads me to this very important question. What are the important things that, people must know before they actually make the move to put their money into something like unit trust? What are the top 5 things that they gotta know so that they can feel at peace and have the confidence to, put the money in unit trust, let alone go with you?
Understand. Thanks for the question. I just want to wrap up that part. A lot of times companies have their own track record, right? Funds have their own track record. But I think what's more important is the advisor itself, about how they actually actively manage your fund. How do they actually look into funds that help you switch around, if ideally for free, right? So that is actually the more important part, because that's 90% of my clients that switch over to me doesn't have that kind of service. So I wouldn't say other people are doing bad job, but they probably just invest and then leave it there without looking at it. So it's important. The advisors plays an important role. Okay. So when it comes down to, maybe I would say the top 5 things, right, that people must look into when they invest into unit trust, I would say. Number 1, you have to know what is your clear investment objective. All right. So it comes into
but how many people actually have a clear investment objective? They will just say, I want to make money lah. Correct or not?
Correct.
I make money, the more the better lah.
Of course. And that's what I mentioned at the beginning. Have the end in mind. right? So that's where an advisor's role is to help you understand, hey, what's that objective?
Help them
investment?
clarify what exactly,
Yeah.
right? Because I agree with you. Same goes in life insurance, because that's my expertise, right? A lot of people think, life insurance never enough one. All these agents always gotta buy. In unit trust also, buy, never enough one.
Yeah.
You know why never
correct.
enough? Because there was no clear goals in mind, right? So in other words, you actually help them to clarify when you invest, what is the purpose of this investment, right? Is it to
Correct.
grow a retirement fund, or is it to build up a quick portfolio so that you can go for your skiing holiday in Japan, for example, right? Because
Yeah.
each objective requires will have different time frame, and that will also dictate the type of risk that you got to decide whether you can absorb this kind of risk or not, right? It's like
That's
oh,
right.
next year I want to get married. I want to make on my wedding day, I want to ride on a horse to come and pick up the bride, and that's going to cost you like $2 million, right? So you got 1 year to build up $2 million. Yeah, you have that 60,000. So 60% return thing, right? So the question then becomes, do I have enough capital to build up that 2 million in 1 year? Number one. Secondly, can I take that risk? If the fund grows 60%, it can also go south,
Yes.
40-50%. Can I
That's
stomach
right.
that?
Correct.
Right? So in other words, you have like a doctor, you have a set of, what to ask to help them clarify, right?
That's right. That's right.
So which is very similar, which is a very similar approach to what we do here as well, So I like that. Okay, cool. Please carry on.
Yeah. So first one, it comes down to investment objective, right? It includes of like financial goals, time frame, and risk tolerance and whatnot, right? And second thing, you must know the fund itself, right? Some people, investors, I don't tell me about the fund. Just tell me how much
most people are like that. They don't want to know about the funds. That they don't want to be bothered. Here's the money. Go and do your magic. If you do your magic, if you don't, if you can't achieve your magic, you suck.
Then they'll come back like, hey, yeah. But of course, when you look into the fund, you must have the rationale why you invest into a certain fund, right? It's an advisor's job to tell you why, right? So when it comes down to that, right, you gotta know like what's the track record, right? What's the pattern of the returns like? That's something to have a reference on, right?
So in other words, again, I use a doctor's analogy, right? The funds are like the medication,
correct?
Right? So in other words, you're saying that the advisor should know the medication, and the advisor will advise the client the effect of this medication, what it does, perhaps even the side effects, so that the investor understands what they are getting into.
Right? That's right.
Right.
Yeah.
So don't go with order taker advisors. What you want? I got this. Pick.
Yeah. That's like going to the market and buy veggie already.
That was my experience. That's why I didn't make money. So okay, so in other words, set the goal, right? Know where you want to head to first. Then secondly, the advisor, knowing the goal, will recommend, okay, these are the options, right? But based on where you want to go and your risk appetite, this will give you A result, A side effect. This will give you B result, B side effect. So as the person, as the investor, now I know clearly which exactly already. Then I get to decide. I get to pick what I want, or I can decide to purely follow what you recommend.
We will come in both ways actually. I'll let you know. I'll give you a clear suggestion as an advisor. Clear 3 suggestions about how to go about with your current market, with the current market and the risk profile of the investor. 3 simple.
Like what? Like some. You mentioned something about the current market. Can you elaborate?
Okay. because market changes along the way, right? Because we're looking at this year, there's like a Russian and Ukraine war. So there are things affected like the supply chain, interest rate hike, then which sector will benefit, all these kind of things. Actually, we do look into as an advisor, and that's why we
So how often do you actually update the investors? Because if I'm a married couple, especially with children, I wouldn't have time to go and read up on all these things,
Definitely.
So how do you help me here?
Okay. So we do have like market updates that I do share along the way. If there's no major news, you won't receive a call unless I want to take fun yam cha with you lah. But on a weekly basis, there will be some market updates about how's the global economy doing. Unless there's major news, then I will call. And then on a month-to-month basis, I'll update your investment. Be it up or down, I'm going to update your investment. How's it doing?
Oh, that's nice. Okay.
Yeah, because there's an assurance that, hey, I'm still here looking out for you. And quarterly basis, every 3 months, we actually have a session. Better to come out and just meet in person. And
so that's the third thing already. First thing is clarify the goal. Second thing is pick the right fund or portfolio, right?
Yeah.
Then third is to basically, as an investor, like it or not, you gotta know where the market is heading so that you can make the next decision, isn't it?
Correct. That's an advisor's role, and the investors gotta ask the advisor, right? And the quarterly one is a portfolio management. How's it doing? How are we looking
sort of like
forward
a performance review.
Yeah, performance review, and how do we strategize moving forward? Whether there's a top up or not, then along the way, quarterly we'll do that. Yeah, so we strategize because it's just like running a business. You gotta strategize along the way. If something doesn't go well or something goes well, how do you double down on it, right? So yeah,
so it seems like you have the performance review so that the investor gets to actually manage the risk, right? Because things change so fast. So if I was the investor, I would actually be very glad that you come to me on a monthly basis or quarterly basis to actually tell me, hey, this is what's happening in the market. We got to pivot, and these are the options to pivot, and then I make a decision there, right?
Yeah.
Right. Okay.
It's a two-way basis. We gotta really know what's the objective of the investment, the time frame. Yeah, we must look at the end goal and then what we do along the way to reach there.
So again, let's circle back to couples, young family, right? So what kind of funds as well as risk would you advise these people to take?
It comes back down to individuals. Again, some parents can take higher risk, some cannot. I would also advise to go somewhere between middle range, where it's half equity, half bond.
So first of all, what kind of returns are we looking at? And then if it goes south, what kind of, like, how far does it go?
Usually we'll always advise the middle range is about 8%, to be honest. 8-12%. Yeah. If
it goes south, what kind of how many percent should they be prepared for?
If the worst case scenario, I put 1-to-1. Yeah, ratio of 1-to-1.
What do you mean?
Go up like 10%. If it can go down 10%. to 10%. Yeah.
Right.
Yeah.
Okay,
yeah. Okay. It's to manage expectations as well. But at the same time, we're not gonna realize the loss.
Again, what kind of what kind of investment would you advise them to put up with so that they can achieve their goals of building the education fund or even perhaps retirement funds?
Okay. Investment, I would say it'll be both lump sum and on a month-to-month basis.
Roughly, so what kind of amount are we looking at? Let's say if this couple or this family, their take-home income on a monthly basis is, say, let's just say 20K collectively, right? And let's say their commitments are about 80%.
80%.
Yeah. So
That's
what would you advise?
80%. Wow, suddenly cannot count. How much is that? Okay, maybe
so 8,000
I
also. That means they have
8,000.
a cash flow of 2K every month.
Yeah.
Yeah.
In that case, right, then I would suggest any amount that's set aside already for preparing for investment, I would diversify part of it into investment as a lump sum. And then out of this 20% remaining, right, I'll allocate about 5 to 10% into on a monthly basis.
Sorry, you mean the 2K you allocate 5 to 10%, or I didn't understand what you mentioned?
Okay, so because you mentioned there's like 20,000,
they take home 20,000, 80,
yeah,
8,000, 80%, which is, let's say 16,000 is already
16,000
goes
is
to
already
commitment. They have about
correct.
4,000 my
remaining.
math. They have about 4,000 remaining, right?
Yeah.
What would you advise?
So our advice between 1,000 to 2,000 would be on a monthly basis. At the same time, if they have the lump sum set aside earlier on already, they're coming in with the lump sum first, and then it'll be on a month-to-month basis, 1,000 or 2,000. And the other 2,000 that they have, because out of 4,000, 1,000 or 2,000 is to actually allocate on a monthly basis. The other two, I would suggest them to prepare for rainy days. Yeah, because these days we really don't know what's going to happen. And my job as advisor is not to still put everything into investment. So yeah, that's for these parents. Actually, you mentioned about children's education. You can actually look into cash investment, which is what I suggested earlier, right? For retirement basis, right? Some
cash
can
investment?
actually come in. Yeah, cash investment. Some people who comes in for retirement funds that are
sorry, you mentioned about education fund go into cash investment. Can you elaborate?
Yeah. So because the cash investment means they invest with cash lah. Yeah, invest with their cash for
okay. Yeah, you mean monthly contribution?
Yeah, monthly contribution. I'll just clear it up. In terms of building their education fund, the children's education fund, they can do lump sum, and then with the remaining of 4,000, I'll allocate half of it into on a monthly basis. That's to build children education fund. For retirement fund, later part they can still come in with cash investment, which is similar to the education fund one. But on the other hand, people who are contributing to EPF already, they've been working for many years, they can allocate a small portion from their account one and diversify into funds to get more returns from the EPF compared to the EPF.
So for the retirement, so for the folks who wants to use build up their retirement funds, they can actually just take money out from the EPF and transfer it into whatever funds that you mentioned about to actually speed up the growth.
Yeah.
So in other words, they don't have to fork out a single cent.
Correct. That's right. It's a cashless investment in a sense.
Okay.
It'll go directly from your KWSP account one directly to the company. Yeah, so there'll be just paperwork being done lah.
Right.
And at the same time, these funds.
But how risky is this?
So these funds are actually KWSP approved funds. So KWSP also know that your funds are for retirement. They wouldn't want you to be exposed to so much risk. So these funds are approved by KWSP, so it's on a medium range risk.
So medium range meaning the risk is it can go south 8 to 12%.
Yes, correct. You're right. Okay. Pick up very fast.
Well, 8 to 12%. As they say, when it comes to investment, every investment comes in pairs, right? The ROI, which means the returns has a twin. You can go up 100%, you can come down 100% as well. Right?
Yeah. Correct. So those are EPF approved funds, so they can allocate. After you do the calculation with some requirements of basic savings and whatnot, of course, there's a certain calculation to it. some people are not even qualified to do so because they don't have enough insight.
Right.
Yeah.
Right.
So
I think at the end of the day, hearing from what you say, it seems like, it confirms that the fundamentals doesn't run away. It doesn't matter what you put your money into, right? You gotta know, or rather, you gotta clarify first of all your goals. Because once you clarify your goals, it will tell you, you'll be able to know how much you can afford to lose, how much you can afford to invest, and how much you want to build up, right? And then secondly, which leads to the second thing, whereby once you clarify your goal, find someone who is able to advise you to pick the right instrument, right? And then thirdly, just like anything, be it our health, be it maintaining a car, be it maintaining a house, there needs to be periodic checkups. So in this case, it's the fund performance review, right? Because if it goes up, yay, right? If it goes down, instead, rather than blaming the sky, the politics, and the agent, it's time to actually the review's purpose is actually an opportunity for us to make a decision to pivot, right? Okay, right. Nice. Okay, so for people who wants to learn more about the types of funds, right? What have you got for them?
What do I have? Actually, two things. One is either we come on 101. We have meet over a coffee, and then I share with you thoroughly. Or the other part is we're doing a 2 days. We're doing a 2 days where we actually teach people about how one small part of it is about the investment part. So from these 2 days, you can actually gain a lot about investing into unit trust as well.
Yeah, speaking of the 2 days, just to give people context, Arthur and I are actually rolling out a workshop, and the purpose of this workshop is to teach people how to actually bulletproof your income, right? Why we say bulletproof is because when it comes to putting money into investment, there is no guarantee that it's gonna make money. There is also no guarantee that you will not lose money. Any investment, you will lose money, but given enough time, if you put in place the right strategies, you may be able to eliminate losses and increase your income. And we're actually rolling out this workshop to teach people how to understand your risk profile, right, Arthur? And then how to, by understanding your risk profile, how to actually set, I would say, goals that is actually that actually make sense, right? Want to make more money is not a goal, it's a want. But if you can set the right goals, then that will actually safeguard you from losing a lot of money. And then we actually have a strategy in place to help you perhaps even zero-rise your risk. But we're still fine-tuning. It's coming soon, right? So for those of you who would like to speak to Arthur and even want to learn more about what kind of funds is suitable for you, you can click on the link down below. Register yourself for a coffee session, right? And when you register yourself for a coffee session, Arthur is going to give you a surprise gift. And you find out what it is when you register. All right. So Arthur, thank you so much for spending this morning with us to actually educate us about, or rather, bust the myth about unit trust, right? and from this session, I would say that I learned something new, right? Particularly now I know that the funds, the fees are actually negotiable. Damn it, why nobody told me this earlier? Right? And that's a good thing. And the second thing is like in all things, it's not about putting your money there and then let it be. There should be updates, periodic updates, just like, you know, how a dentist would update us, and just like how we periodically do health check. The investment itself has a life of its own, and we need to constantly, do health check. And the way you do it reminds me of the approach that I take as well. Is like we gotta constantly review whether the funds is matching our goals, and if our goals change, if when do goals change? If people get a job, lose a job, start a business, get a new property, sold a property, have kids, whenever all these things change, the goals will change, right? And when the goals change, that's where we need to start reviewing all this financial portfolio, right? And I like the fact that you also said, looking at the economy, while people think, recession is coming, it may not be as bad, right?
Recession is required, by the way.
Yes, it's part of the economy system, right?
Yes.
But the good news is that it's not as bad, and based on your research, bear market lasts about one to 2 years safely, right? If I may, roughly 1 to 2 years, and if you can hold it, it's actually not that bad, right? Yeah. So that's a fantastic session that I had with you, and I look forward to more sessions with you, and then let's do coffee soon. All right. Thank you very much, Arthur.
Thank you so much for having me, Joel, and thank you so much for all those people that are tuning in. Right, I'll see you guys soon.
Okay.